In this series of videos, I will seek to conclude in a detailed trend forecast for the stock market for the whole of the remainder of 2018. This analysis is based on my articles being posted at the Market Oracle site. Furthermore, the whole of this analysis was made available to my patrons for their support of my work. So, for immediate first access to this and all of my future analysis, then do consider becoming a patron by supporting my work for as little as $3 per month. The inflationary exponential stocks bull market. This is a good time to remind my viewers of the difference in perception between bull and bear markets, for they are not the same. The stock market does not exist in a trading range that oscillates between roughly equal bull and bear market price gyrations. The primary overriding trend is always inflationary, which means bear markets are mere corrections. In fact, we are currently in the mother of all bull markets, even if my expectations since Trump got elected have been of a mature bull market set to experience a series of significant corrections of 8% or so, as was my expectations of early 2018 for a Dow target of 23,000. So whilst today the bears are once more blaming the Fed for the failure for stocks to fall, but it's not the Fed or the corporates for buying back their own stock, or that the markets are manipulated, all without understanding the fundamental fact that the market is the sum of all of its actions, and the only place where this can be seen to become manifest is in the price. Just as I stated in March 2009, right at the beginning of this stock's bull market. So the only thing that actually matters is the price. Nothing else, and I mean nothing. Not earnings, not fundamentals. Listen to the price or you will miss the stock's bull market. And remember, this is what I've been stating for the 8-year duration of this stock's bull market, that the Fed and the rest have been manipulating stocks since at least October 1987, the day after the crash when the Dow bounced. Where my message for the duration has been very simple, one of the greater the deviation from the bull market peak, then the greater the buying opportunity presented. And even though all bull markets do eventually come to an end, however, that end always tends to prove temporary, soon appearing as inconsequential blips on the long-term trend chart, as the overall inflationary stock market trend is exponential, which is why the great stock market crashes of the past, such as 1929 and 1987, are barely visible blips today. And similarly, the likes of the dot-com bubble bear market and financial crises have already been diminished in significance in terms of the long-term trend. It does not matter that much whether one bought stocks near the 2007 top, let's say Dow 13,000, or towards the bear market bottom at say 8,000, in terms of the current value of one stock market holdings at Dow 25k. And definitely not when compared to what the perma bears would have experienced if they had actually shorted stocks at any point that their mantra proclaimed that final top was in, and then held those shorts as the Dow rallied to over 25,000. So bear these 2 points in mind when investing in stocks. Number one, the greater the deviation from the bull market peak, then the greater the buying opportunity presented. And two, the long-term inflationary stock market trend is exponential. Thus, the reality of all bear markets in the general stock market indices such as the Dow is to present investors with their latest stock buying opportunities in advance of the resumption of what is an inflationary exponential stock market trend, all whilst the bears perpetuate non-existent deflationary scenarios. This analysis continues in part 3, which will take a look at Elliott waves. So ensure you're subscribed to my YouTube channel for that video, whilst for immediate and first access to all of my analysis, then do consider supporting my work by becoming a patron for as little as $3 per month.